Now we are in the second part of Unit 2, and that is about capital structure. Your capital structure means a combination of various capital that company used. Okay, generally, mainly we have two options for a capital, equity and debt, and third one is a preference. So the capital structure means a mixture or a combination of different sources of finance called equity, preference, debt, long-term loans, and retained earning. So capital structure represent the mixture, represent the combination of different capitals that company use. In accounting language, capital structure is equal to total assets minus current liabilities. And here, optimum capital structure, very, very important for 1 mark. The optimum capital structure means a capital structure which maximize the market value of the company and minimize the overall cost of capital. So maximum benefit at minimum cost, that called optimum capital structure. Then after, next one is forms of capital structure. Mainly 4 forms are there, or types of capital structure. Only equity capital, equity shares and preference shares, equity shares and debentures, equity shares, preference shares and debentures. Most of the companies are using 4 type of capital structure, that equity plus preference plus debenture. Next one is the determinants of the capital structure. I'm not going for a detail of each and every point, just I read out the points. Financial leverage, growth and stability of the sales, cost of capital, cash flow ability, nature and size of the firm, control, flexibility, requirement of investors, capital market condition, structure of the assets, period of the finance, purpose of financing, cost of flotation, personal consideration, corporate tax rule, and risk and competition. The 17 points are there. You need to remember any 8 to 9 points. You are not supposed to write all the 17 points. You are free to write any 8 to 9 points in 8 marks. In 4 marks, you can write 4 to 5 points. Now the next one is very, very important for the mid 2 as well as for the final examination. So please be here. Theories of capital structure. In our syllabus, mainly we have 3 theories. Okay, net income approach, net operating income approach, and Modigliani and Miller approach. First, we start with the net income approach. This approach, NI approach, net income approach, is given by David Durant. Okay, and according to this approach, capital structure decision is relevant to value of the firm or valuation of the firm. It means there is a relation between capital structure and value of the firm. So let me explain this. Okay, here capital structure means mixture of equity, preference, and debt. So if company change the proportion of equity or a debt, it definitely change the value of the firm. This is the conclusion of this theory. Now use the main keyword of this entire theory is, as company use more debt finance to reduce the overall cost of capital and increase the value of the firm. So according to this approach, according to the David Durant, it is says that if company use more debt capital, more debenture, more loan, then it will reduce the overall cost of capital and it will increase the value of the firm. Okay, you can see here, as company use more debt, RD, as RD is increased, RA is declined, RE remains same, and value of the firm will increase. Now see here the adductions. 5 adductions are there. No corporate tax, Cost of debt is less than cost of equity. Use of debt does not change the risk about the risk perception of the investors. Okay, and total capital requirement remains same. KD, cost of debt capital, and KE, cost of equity capital remains same. So assumptions are KE remains same, total capital remains same, cost of debt is less than cost of equity. Okay, risk remains same, and no corporate tax. Please remember, when question asks about the NI approach, write down these 4 lines, adaptions. Okay, draw this diagram and note down the formula that RA is equal to RD D upon D plus E. That's all. This is all about this theory. Okay. Next theory is net operating income, NOI. Shortly, it is known as NOI. Please remember the full form. NOI stands for net operating income. Again, this theory is given by David Durant. Okay, and this theory is opposite to NI approach, opposite to the previous theory. And according to this theory, there is no relation between capital structure and value of the firm. It means either company use equity, either company use debt, either company use preference. It does not affect the market value of the shares. So according to this approach, the change in capital structure will not lead to any change in the total value of the firm. Assumptions: cost of capital remains same, no corporate tax, KD, okay, remains same, here KE, okay, cost of equity remains same, total earning, okay, of the firm to be find value of the firm as a whole. Okay, the total capitalization and total earning remains same. Use of more and more debt in capital structures increase the risk of the shareholders and thus result in increase of cost of equity capital. So now please try to understand here that as company use more and more debt, okay, it will increase the risk perceptions of the equity shareholders, and equity shareholders will demand more dividend, and as a more dividend it means cost of equity capital will increase. So according to this approach, if company go for the debt capital, if company use the more debt capital, whatever the benefits are there, that benefits goes to the equity shareholders because equity shareholders demand more dividend. Okay, this is the diagram. You can see as RD increase from left to right side. Okay, RA, cost of average capital, remains same, but RE, cost of equity capital, will increase. Formula: RE is equal to RA plus in a bracket RA minus RD, bracket over in a second bracket D upon T. Next and third, it is very, very important for all of you for a 1 mark and for 8 mark theoretical question. Approach. Please remember, model or approach stand for Modigliani and Miller. This approach is presented in 1958, and again this is irrelevant approach. It means according to this approach, the capital structure of the company does not affect the value of the firm because according to Modigliani and Miller, there is a perfect capital market, and in the perfect capital market, nobody will change the price, nobody will change the value. Okay, the value price will decided by the market itself. And in the other words, okay, that average cost of capital does not change with the change in the debt weightage, equity mix, or a capital structure of the firm. So what saying that whether you use a 60% debt, whether you use 80% debt, or whether you use 20% debt, it does not change the overall cost of capital, and it does not change the market value of the capital. Market value of the company. And the key line of this entire model, model, is there is nothing which may called the optimum capital structure. According to there is no capital structure in the real world. Assumptions: that market is perfect, Okay, capital market is a perfect. No return earning, no corporate tax, investors are rational, 100% dividend, and the risk remain same. These are the assumptions that you need to remember. Okay, now theory of says that if two firms alike in respect accept the difference in the respect of their financing pattern. This both Modigilan and Miller say that suppose there are two companies and both the companies are similar. Both the companies are doing same operation, producing same products and selling same products for the customers, but there is only one change in the capital structure. In one company we have equity and debentures, in the second company we have only equity. Then investor will develop a tendency to sell the shares of the overvalued firm and to buy the undervalued firm shares. Now, what happened that those companies have a higher value. Okay, shareholders sell their shares because this is overvalued. Actual value is not that much, but due to this conclusion in the price, there is overvaluation. So all the shareholders sell that firm, suppose A. Okay, shareholders share the shares of A, whereas in another side, investors or shareholders are ready to buy the shares of undervalued. Those companies are doing good, but they are undervalued, and this buying and selling pressure or a process remain continue until both the companies getting the same market value. Okay, suppose A company having a market value of 20 and B company having market value of 10. So investors sell the shares of A, selling. Okay, and investors buy the shares of B, purchasing, buying. This buying process, selling process remain continue when both the companies are getting same value. It means A will get 15, B will get 15. Up to that level, this buying and selling of A and B remains. So this is the entire theory of So this is all about our capital structure theories. Mainly three theories are there: net income, net operating incomes, and Modigliani and Miller income. And one remain theory is there. Okay, that is called a traditional approach or a traditional theory. And traditional theory is nothing new, but it is just a mix of net income approach and net operating income. NI and NOI mixed approach is there, and that's why sometimes it is also known as intermediate approach. And according to this theory, if company use a debt or equity up to a certain level, okay, it is fine. Suppose up to the 5 lakh company use a debt, company use a loan, it is fine. If company use more debt beyond the 5 lakh, it will increase the cost of capital as well as it will reduce the market value of the firm. So up to a 5 lakh, company can get the maximum benefit. There is an increase in the value of the shares, value of the firm. But beyond the 5 lakh, there is a declining in the value. So these are the four theories that you need to remember for a mid 2 and for a final examination.